Hello, everyone. Let's start with the first reading of FSA, Financial Statement Analysis. Under FSA, uh, we are not expected to make financial statements, as in, learn how to construct balance sheets or profit and loss statements, but you are expected to analyze what these balance sheets, what this profit and loss statements, what the cash flow statements are telling to you about the organizations. So the first step is, how do we what is the framework of financial statement analysis? The first step is state the objective and the context. The analysis will depend upon what your objective is. Like, if your objective is to analyze whether the company is good for investment for 5 years, or if your objective is to analyze whether you should lend some money into the for the company for the 5 years. So first state what the objective is, because whatever your objective is, the framework of your analysis or how you would perform your analysis, that would differ. So first state the objective and the context. Second, gather data. Whatever data you'd be needing, the balance sheet of the company, the profit and loss statement of the company, cash flow statement of the company. Along with this, maybe there would have been certain conferences that the company's management would have done. So you get the recordings of uh, those conferences, or you get the release notes by the management of the company. So gather whatever data you require in order to make your decisions or to analyze everything. Then process the data. No, you have gotten the balance sheets, you've gotten the P&L. Now you want to analyze, we want to read what these statements are telling. So maybe you want to calculate ratios, you want to make graphs that, okay, in the past 5 years, the income has, the income is looking like this. So you can make a graph in order to analyze these things. You can make ratio, you can calculate ratios. So we prepare or we process the data according to our needs. So we prepare the data, then analyze and interpret the data. So you have prepared the data. So after preparing the data, whatever ratios you have gotten, whatever graphs you have made, in the fourth step, we use that data in order to analyze and interpret and decide and make conclusions. Then we report these conclusions or recommendation, that, okay, after analyzing everything, I think this is the conclusion: you should buy the stock, or you should not buy the stock, or you should lend money to the company, or shouldn't lend money to the company. The first and the last step is update the analysis. So after every year, let's say, or after 6 months, whenever the company's performance reports are changing, or whatever changes are happening into the market, make sure that you keep updating your analysis, and if there's any significant change, then again communicate that change to the relevant stakeholders. Describe the roles of financial statement analysis is our next LOS. So we have financial reporting definition and FSA definition under this. Financial reporting and financial statement analysis. So what is financial reporting? Financial reporting is preparing these financial statements. So you prepare the financial statements and you present them to the relevant stakeholders in the way they require. That is, your creditors may require your financial reports, your stakeholders may require, your clients may require. So financial reporting is preparing the financial statements in the way that is required by the various stakeholders. Financial statement analysis is that you analyze these financial statements for whatever objective you have. You want to give debt to the company, or you want to invest into the company. So you analyze these financial statements which have been prepared by the company. You calculate ratios, you make graphs, you make conclusions, recommendations. So this process is called financial statement analysis, and financial reporting is basically making these financial reports. So we have two types of bodies. We have standard setting bodies and regulatory bodies. Standard setting bodies, or we have regulatory bodies. Standard setting bodies are what? These are professional organizations. Standard setting bodies consist of professional organizations, like people who may have completed or gotten the required degree. So these bodies, they make standards which are expected to be followed by people under the professionals. Regulatory bodies are responsible for making the regulations. Regulatory bodies are the government organizations who are responsible for making the regulations. They make the legal authority to enforce compliance with standards. So, standard setting bodies are the persons or the people, they are the professional people who make the standards, and regulatory bodies, which is the government, they force compliance with the standards. They would look that all the companies, all the professionals, they are following the standards. So they impose legal restrictions on them that you have to comply with the standards. So we have two primary setting bodies. We have IASB, and we have FASB. IASB is International Accounting Standards Board, and FASB is Financial Accounting Standards Board. So IASB is responsible for making standards, IFRS, International Financial Reporting Standards, and FASB is responsible for making US GAAP. United States Generally Acceptable Accounting Principles. So IASB is the standard setting body. FASB is the standard setting bodies. IFRS and US GAAP are the two. IFRS and the US GAAP are the two standards which they have set up respectively. Then under regulatory bodies, we have SEC, Securities Exchange Commissions. We have SEC in United States, or Financial Conduct Authority, FCA, under UK. So in UK, FCA is responsible to see that all the people, they are following whatever standards have been set. So FASB has set up US GAAP, and IFRS has set IASB has set up IFRS. IFRS, or International Financial Reporting Standards, is something which helps to bridge the gap between the different financial standards in different countries, so that companies or the MNCs which are present, which have a global presence, they do not face that problem of reporting their balance sheets, their P&Ls, basically reporting the financial statements according to the various different standards which are present out there in the world. Now, most national authorities, they belong to International Organization of Securities Commission, IOSCO. The members of the ISCO, what they do, they regulate more than 95% of the world's financial market. So they IASCO, they are responsible for regulating the financial markets of the world. So this is not just a regulatory body, but the members of IOSCO, their motive is that they improve national cooperation, Again, so the companies around the world, they have the ease of reporting their statements, and there is not a misunderstanding, or they cannot find a loophole that, okay, if I present the statement in such a way, this company won't be able to use my statement. So they want to improve cross border cooperation. The main objectives of three main objectives of IOSCO is protecting investors, ensuring markets are fair, efficient, transparent, reducing systemic risk. That is the risk which is present in the market itself, the risk which is present in the system itself. Next comes proxy statements. Let's say a company has decided something, and that decision needs to be, that decision needs to be voted out, that decision needs vote from the shareholders. So proxy statements are issued at that times. Proxy statements are issued to shareholders at that time when there are matters that require their votes. These proxy statements, these are also filed with SEC, Security Exchange Commission. So these are also filed with SEC. So these proxy statements are a good source of analyzing, good source of analysis. They are good source of analysis of election of board members. Whenever any board member has to be elected, whenever any decision has to be made regarding the election of board members or the compensation of the board members, nomination of the board members, proxy statements needs to be issued, because it would require that the shareholders vote for these things, for these decisions are needed. So this is the proxy statement. Since they're filed with SEC, they're a good source of these information. Next is financial statement notes or footnotes. Now, there are many information about the financial statements which you may not be able to present in balance sheet. That is, let's say you have a contingent liability that so and so person. If that person defaults, I would have to pay rupees 2 lakhs for that person, basically. If I lose the case, let's say the company is fighting a case, and if the company lose that case, the company would be liable to pay rupees 10 lakh. So if there's a contingent liability, now how do you represent the contingent liability in the balance sheet? We do not have any provision to do that. So if there is no provision to show your contingent liability in the balance sheet, but I know whoever is the reader of the financial statement, or whoever is the analyst, whoever is analyzing the financial statements, everyone should be aware that after 5 years this liability can occur. So all these things are presented where they are presented in footnotes or financial statement notes. That is, at the end of the balance sheet, it will be written that this contingent liability is expected if I lose this case. So financial statement notes present those information which cannot be represented in the financial statements, or if you want that your reader of the financial statement understands the financial statements perfectly, like there can be different methods of depreciation. There can be a straight line method of depreciation. There can be a written down value method of depreciation. Now, how do I tell my readers what method am I following, and how do the readers evaluate whether I have done the calculations correctly or not? So these methods are given. Or if you have followed IFRS standard of reporting, or if you have followed US standards of reporting. Now, there would be, many differences between IFRS and US GAAP. Will be whatever readings would be doing. There would be differences under how you report under IFRS, how you report these things under IFRS, and how you report these things under US GAAP. Like when we'll be discussing cash flow statements, US GAAP would be telling that you need to basically file your CFF, cash flow for financing, in such way, but IFRS would tell you that you can do it in such way. So there would be certain differences, and according to these differences, your answers to questions would also differ. So what I would suggest is that you just make a table, US GAAP, IFRS, and a subtopic that, okay, the for cash flow, so for financial activities, or for cash flow of investments, of CFO, cash flow for operating activities. You make headers here, and under this case, IFRS is telling you to do this thing, US GAAP is telling you to do this thing. So throughout financial statement analysis lecture, you make those differences ready. Like you make these differences and keep them ready, so that at the end, when you are revising everything, most of the things between US GAAP and IFRS would remain same. There would be like 10 differences between US GAAP and IFRS. So after the revision, you are not spending time thinking that, okay, what was the difference between IS GAAP here and US GAAP, IFRS here and US GAAP there. So when you have the differences ready, you know that everything is the same except these things. So you would have the exhaustive list prepared with you. So be sure that you are making that list. So under financial statements note, you basically tell the reader that I have followed US GAAP or I have followed IFRS for such presentation. Whatever accounting methods you have followed, whatever assumptions you have taken, that I have taken the assumption that the depreciation rate will be 7%. So all these things need to be presented in the footnotes, so that the readers are aware that how do they need to analyze the financial statements. Along with this, these are also audited. Whenever the auditor is auditing the financial statement analysis, the primary financial statement analysis, the balance sheets, the P&L, the cash flow statements, along with those things, the footnotes or the financial statements are also audited. After that, there are certain filings which needs to be done by a company, by an organization. There are certain SEC required filings. First is Form S1. So under, like, for this section, you need to know that what kind of form needs to be filled in under what kind of circumstances. So Form S1, we have Form 10K, Form 10Q, Def 14A, Form 8K, Form 144, Form 3, 4, and 5. So Form S1 needs to be filled for sale of new securities. So if a company is bringing new securities in the market, or if the company is bringing stocks into the market, so company needs to fill Form S1, denoting what the purpose of issuing these securities are, what the company would be doing with this money, what the prospects of the company are. Form 10K is a required annual filing. So it's filled annually. So Form 10K basically tells what the risk of the companies are, how the company is managing this risk. So it's very similar to the annual filing the company does, but it's not a substitute of the annual filing, or annual filing is not a substitute for Form 10K. Form 10K is filled quarterly. about whatever changes have happened in the quarter, if there are any significant changes. So Form 10Q would be filled for that. Form 10Q is filled quarterly. Def 14A is filled when proxy statements are issued. So whenever proxy statements are issued to the shareholders, along with that, you also need to fill in Def 14A. 8K is filled in to disclose material events. So if there is any material event, that is the company has acquired anything, the company is deciding that they are disposing an asset, that is they are securing an asset which was very significant for the company, or the significant to the company, or the company has decided that they would be not they would be hiring a new members for an important position, or the company would be removing an important person from the organization. So any material event which is happening, Form 8K needs to be filled. Form 144, like if the company wants to issue securities to some qualified investors, they do not need to fill Form S1, they can just fill Form 144. Issue securities to qualified investors. Now, Form 3, 4, and 5 involve the beneficial ownership of securities by a company's beneficial ownership of securities. So, if the company's officers, company's directors, they are holding any shares of the company, they are holding anything which benefits them, which belongs to the company. So, they need to fill these forms. So, whoever the analyst is or whoever is analyzing the stocks, they know that okay, the officers or the directors, they hold this much stake in the company. Coming to the next topic, which is business segment and geographic segments. So it's not generally not required that the companies file their financial statements according to the segments until and unless that segment is very crucial, or that segment is very significant. So if that's not the case, the company is not really expected to report segment wise data. Business segment is what, when you make up segments according to the different types of businesses you are dealing in. Let's say you have an airplane business, so you are making up so let's say you have a business, so you are making up different segments according to the type of businesses or the different types of products or services they are offering, products and services. So you have an airplane business. You have one segment which is the commercial airline, open for everyone. Next, you can have an airline which is not commercial; it's private. You are offering jets to people, to corporate people who want to just fly to and fro. There can be your different leg, which is like the defense airline. You are providing airlines or jets to government for the security. So these you can divide your business segments into different products and services you are offering. A business segment is a portion of a larger company that accounts for more than 10%. So a segment, you can call it a segment if it accounts for more than 10% of the company's assets, revenues, income, and so on. Segments reported should account for a minimum of 75% of the firm's external sales. So whatever segments you are reporting, that you have three segments, so these three segments should combine should have at least 75% of the firm's external sales. So the following must be disclosed for each segment. You must disclose for each segment what the revenue of that segment is, what is the measure of profit and loss, what is the measure of assets and liabilities, the interest, the depreciations, the other non-cash expenses, the tax expenses. So everything you need to report segment wise. Geographic segment is when a company has its presence globally, so the company can divide its operations into geographic segments. That okay, I have my operations here and here, and this is one segment, this is one segment, this is one segment. So according to geography, according to the different locations the company is established into, the company can report its financial statements. Next topic is management commentary. Also known as management discussion and analysis. What happens here, the management of the organization, they comes here and they talk about what the perspectives of the company are, like beyond whatever financial reporting statements are published. They talk about what will happen if what if the interest rates fluctuates in the future. Will it have any material impact on the company's operations or not? What the company is looking for in the future. Is the company looking for a merger? Is the company launching a new product? What do the managers feel about the company's future perspectives? La- like, are there any off sheet balance obligations? Are there any off balance sheet obligations the company has? What will the impact of interest rate? What would be the impact of exchange rates? What other expenditures and incomes the manager is looking for in the future? So it tells how sure the management is for the management is about the perspectives of the company, and the analyst should know that some part of management commentary is unaudited. Like we discussed, footnotes were audited. Then we discussed proxy statements were to be filed with the SEC, because we also learned that there was def 144A, which was required to be def 14A, which was required to be filed in when any proxy statement was issued. So but what's the difference between all those things and here? Management commentary, some parts of the management commentary is unaudited. That is, if you're analyzing something, you should be aware that it's not necessary that the auditor has gone through everything which is present in the management commentary. Then comes, what is audit? Audit is an independent review of the firms or entities financial statements. So the accountants and the public accountants, they review the firm's financial statements. They see whether everything has been reported according to the required standards or not. Is everything followed perfectly? Are there anything which they should be concerned about, or they should report it to the organization? So they do independent review of the firm's financial statements, and then they give out their judgments. These judgments can be, it can be an unqualified opinion. It can be qualified opinion, adverse opinion, or disclaimer of opinion. So the auditor can give an unqualified opinion that the auditor believes that everything is perfectly, the entity has maintained the financial statements perfectly. There is nothing which is not true and fair. if the auditor believes that everything has been is like perfect except one thing which which the auditor wants to highlight to to the analyst or to the organization, respective organizations, then the auditor can issue a qualified opinion that everything is perfect except this part. I believe that this part should have been calculated like this and not like this, or this part should have been reported like this and not like this. So I do not believe that this part is true and fair, except that everything is perfect. Adverse opinion is if the auditor believes that the financial statements do not have anything which is true and fair. The whole financial statements are prepared in a wrong way. No, at nowhere are the required laws followed. So the auditor will issue adverse opinion. Then disclaimer of opinion would be that the auditor was in a position that they were not able to express opinion. Like the auditor wanted that I want these and these financial statements to be given to me. Like along with this, I also want manager whatever MDA management commentary has been done. I want also those. So if the organization fails to present all the information, all the required information the auditor needed to give its judgment, then the auditor can issue disclaimer of opinion, that is the auditor was not able to express the opinion. The auditor can also give an explanatory paragraph according to whatever material losses the auditor believe would happen in the future. That is, okay, in future I expect that these are the material loss the company may be facing. Now, there was a Sarbanes-Oxley Act which prevented the auditor for giving, uh, apart from like the independent review, apart from performing this review of the financial statements, Sarbanes-Oxley Act prohibited the auditor from giving any services beyond this review, so that the auditor and the company do not have any relationship beyond this analysis of financial statements, and whatever analysis is done, it is true and fair. Then comes internal controls. So internal controls, they are the processes by which the company ensures that it presents accurate financial statements. So these are the controls the company has placed into the organization, so that whatever statements are prepared, they are accurate. And this whose responsibility it is? It is company's management's responsibility that the internal controls are in place. Now, for an analyst, there can be two types of sources. There can be internal sources, there can be external sources. Whenever the analyst would want to analyze the any company, so we have issuer sources. Issuer sources is the information or the reports the analyst get from the issuer itself, the company itself. It can be earnings guidance, earnings call. Like before presenting their financial statements, before releasing the financial statements, the company can held an earning calls for the analyst, describing them what the financial statements would look like. Again, this earnings call or earnings guidance would not be audited. It can be ad hoc presentations, any presentations the company's management has given, any press releases by the company. So issuer sources are the sources which are given by the company. The analyst is analyzing. Then there is public third party sources. These are the kind of sources which are out there available to you, free of cost, and you haven't paid for them. So it's a third party sources. Like any third party, any researcher has conducted an analysis for the company which was not specific to your requirement, so you can use that public third party resources. Then it is what are the examples of public third party resources? Free industry reports, white papers, trade journals, government agency, produce economic and industry statistics, social media. Then there are proprietary third party sources. That is this analysis has been done by a third party, not specific to you, not specific to your requirements, but you have to pay in order to get access to this resources. These are analyst reports, reports from data platforms such as Bloomberg, Win, report from industry specific agencies and consultancies. Next comes proprietary primary research. You have paid any researcher, any analyst to do research specific to your requirements. Studies commissioned by the analyst, hand-on experience with the company's product or services, data and advice of technical specialists employed by the analyst. So you have employed anyone or you have done this research specific to your requirements. So this is it for the first reading of FSA.